So we're going to go ahead and get started. My name is Elizabeth Aloni, and I'm with Schneps Media. Schneps Media is the largest local media company in New York. We publish over 73 newspapers, magazines, websites, webinars, podcasts, and events throughout Queens, Manhattan, Brooklyn, the Bronx, Westchester, Long Island, and Philadelphia. We are thrilled to have today with us an expert in his field, Robert Tollin, and he is going to be talking with us today about closing the retirement gap using home equity. Welcome, Robert.
Thank you, Elizabeth, and thank you, Schneps Media, for having me today and getting this information out there at a very crucial time, actually, with everything that's going on.
Absolutely. Let me tell you all a little bit about Robert. He has been a mortgage consultant since 2001, and he's been specializing in educating homeowners, their families, and trusted professionals alike, whether it's at their kitchen table or their advisor's office, and now even on Zoom, about the pros and cons of refinancing their existing mortgage. He is most proud of his designation of Certified Reverse Mortgage Professional. Only 145 individuals nationwide currently have the CRMP designation. And last reported by the Bureau of Labor Statistics in May 2018, there were over 300,000 loan officers. Robert is a New York State approved technical instructor for the Long Island School of Real Estate and certified to teach continuing education for realtors. The class covers how to purchase with reverse financing. Many professionals are unaware that seniors can purchase a new home with a reverse mortgage by putting down approximately 50% of the purchase price. The borrowers have the choice of whether to make a payment to preserve home equity. Nationwide Mortgage Bankers enables Robert to provide a full suite of loan products for residential 1 to 4 family homes. He offers an array of first-time home buyer products and is passionate about educating you about the purchase process. If you're looking to stay in your home and utilize home equity to help lower your monthly bills or take cash out, then he certainly encourages you to reach out to him. And he looks forward to having a conversation with you and generally is interested in getting to learn about your wants and your needs. He is licensed also to work in California, Connecticut, Florida, Maryland, New Jersey, and Pennsylvania, and of course in New York. It's my honor to introduce you to Robert Tollin.
Thank you for that very warm and thorough introduction. I feel like we're done. No, thank you very much, and I look forward to answering many questions. We'll probably look to hold off many of those questions towards the end of the presentation. I do have like a 43 slide deck to get through. Some slides I'll move pretty quickly through and may skip just because of the time constraints of this presentation. But we are going to talk about how home equity can really close the gap with retirement. And with that being said, let's take a look at what we're going to learn today, some objectives. So section 1, we're going to go through just really the basics of the reverse mortgage and what they call today the HECM. That's the acronym that you'll see around this program, standing for Home Equity Conversion Mortgage. We'll talk about program features, some of the other details, the process of getting a loan, as well as scenarios and uses of the program, which hopefully will start tying this product together, and you can see how it could either apply to you, someone you care about, or potentially a client if you're a trusted advisor. So the importance of home equity. There's some new academic research out there that is really demonstrating how home equity conversion mortgages, the reverse mortgage, can really play a vital role in the retirement planning. And it's not just a tool of last resort. You know, when I've been in the mortgage business nearly 20 years now, and I really took a passion to this product back in 2007. And I can certainly say back in 2007, it really was kind of, coined the last resort type of loan. And most of the inquiries I would get from, my referring partners was usually the last resort type loan. Borrowers couldn't afford to stay in the house unless they tapped the home equity. We think this program has changed. I know it certainly has for a lot of my borrowers and the loans that I'm doing today. It really does provide greater financial flexibility to all seniors looking at home equity. So with that being said, let's get to the basics. Again, a home equity conversion mortgage is a loan that gives homeowners access to a portion of their home value. Some people off the top of mind may think, oh, my home is, valued at $500,000, 500,000. That's $500,000 that I can borrow. It's not the case. You'll never on any type of loan product, and that's what a reverse mortgage is. It's a loan against the house, just like any other loan. It does offer other flexibility. You're gonna qualify for a portion of the home value, and you're gonna hear me speak a lot about 50%, because that's kind of where homeowners are landing in this environment today. At age 62, is a touch over 50% against the home value. All right. The loan that you're getting, or the monies that you borrow from your home, do not require you to make a mortgage payment until you permanently leave the home, or another maturity event occurs. So maturity event would be death, right? You're no longer with us, or you're no longer maintaining that home as your primary residence, or for some reason you didn't live up to your obligation, which is always continuing to pay the property taxes, the insurances, your carrying costs, and certainly, keep your house in good repair, right? So again, here's a note: the borrower must pay the property charges, taxes, fees, hazard insurance. This loan is called non-recourse, which means that the lender can use only the property to satisfy the lien. So I like to say non-recourse really means no personal liability. So in the event, and you may have heard that, you may not have any equity left with a reverse mortgage, which can be true. Not likely today, but years ago, the way these loans were set up, with people living longer and longer, and how much money people were able to borrow years ago, there was a chance where, if someone lives long enough and they borrow a lot of the money up front, that they may owe more money than what the value of the property is worth. If that should happen, there's no personal liability. The bank or the lender can't come after, naturally the family or any other assets that may have been left to the estate. Okay. Let's move along. Some reasons to consider a reverse mortgage, or again, a home equity conversion mortgage. For some people, it's really to eliminate that monthly mortgage payment. That's going to create, it's going to alleviate a whole lot of financial stress, is to just pay off the mortgage that they're paying on, or whether that be a traditional home equity line of credit, and provide that payment relief. Sometimes it's to supplement their income. Many of my homeowners that I work with are still working, but it could supplement their income or supplement their retirement income, right? It could pay for medical expenses or in-home care. We're starting to see a lot of that with wanting to keep mom or dad home with home equity, versus looking at maybe, an assisted living type route, or of something of that nature. What's new, what most people are loving to learn, I'm finding that fascinating, is the ability for seniors to sell their existing home, or maybe just depart their existing home and possibly rent it out if they want to retain ownership, or if they have the ability to maintain it as a second home, but to use the financing to purchase a new home. So earlier I had stated that, I'm going to talk about 50%, that if your home is worth $500,000, you'll be able to borrow 50%, $250,000. Well, it's going to work the same way for a purchase. So if you're purchasing a new home, a new primary residence, which it needs to be, you don't have to take all your proceeds from the sale or assets that you may have in retirement and liquidate those accounts to pay all cash, which is often the key with many seniors. They don't want the encumbrance of a mortgage payment. But you can treat this financing like cash, where you would put down 50%, and the lender would also give you 50% towards that purchase. And we'll talk more about that. Certainly to pay off debt, people use this loan to pay off credit card debt and other liabilities. But I find the majority of people have their own story, and how this loan really, how home equity can really ease that financial liability, or give them the additional income to enjoy their latter years in retirement. All right, but all the time, we've got a little asterisk here. Keep in mind that although you have no mortgage payment or no responsibility to make a mortgage payment, you do always have to pay your property taxes, your insurances, and that would include HOAs if you're in a condo, homeowners association dues, as well as flood insurance. That's a carrying cost if you're in a flood zone. So keep that in mind. So eligibility for the HECM program, that's the government insured program that many of you see my brother on TV talking about, Mr. Tom Selleck, right? 62 years of age. So one borrower, who's speaking about a married couple, one spouse needs to be 62 years of age to qualify. You can certainly have what's called a non-borrowing spouse who may be younger than 62. All right, so 62 and older, if we're talking about the government insured program. I will make a little segue. There's a private program now available in New York that I'll speak about. It's called Home Safe. There's really only one program available right now, and that's age 60. So a couple of years younger, you start qualifying for Home Safe. And again, I'll speak a little bit later regarding the private jumbo program. The other requirements is that at least one borrower is living in that subject property as their primary residence. All right, so it's got to be the borrower. If you're 62 and your spouse is younger than 62, the 62-year-old spouse needs to be living in the home as their primary residence. And we do have to demonstrate the financial capability as well as the credit responsibility, right? So credit and income are going to come into play with this loan today, as maybe years ago it didn't as much. Today it certainly does, and we'll speak about that. And also, there's a mandatory FHA counseling session that someone needs to go through prior to really, moving forward with a, title services and an appraisal. So there's what's called a required counseling. We'll talk more about that, where a homeowner or homeowners are going to need to listen to an approved counselor about what their obligations are in terms of paying the taxes, the insurances, and that it's a loan, and all kind of the intricacies that the loan officer should be reviewing with you as well. And the government looks at it as really as an added protection for the seniors, for the older borrowers, to make sure that I'm doing my job thoroughly, telling you all the good as well as any potential negatives with these types of loans. And it does fall under the government program, falls under the FHA subset umbrella. So this is an FHA rule. All right. Eligible properties, types of homes you can get a reverse mortgage on are 1 to 4 family, so single family homes, 1 to 4 family residences, any FHA approved condominiums. If they're not FHA approved, then we can take a look at the jumbo program, but that's going to command an appraised value or a purchase price of a minimum of $500,000. So anything under $500,000 in the condo world is going to need this FHA project approval. We'll talk more about that. But if it's above $500,000, we can do jumbo. It's also good for townhomes and planned unit developments. We'll see that from time to time. As long as the property is taxed as a single family, which townhomes are, as well as planned unit developments, they're going to be permissible. I said 1 to 4 families, so we do have 2 to 4 unit properties here as well. And something I haven't seen in being that I do most of my business in New York are manufactured homes, and that's going to fulfill a whole set of FHA required, criteria, which I'm not going to review because we really don't come across it here in New York. Right, but we'll follow some FHA rules for manufactured homes.
Robert,
yes.
are you able to make this full screen, like make it like presentation mode?
Is that better
for everybody? That's better.
Okay.
Fantastic.
All right. Thank you for that, Elizabeth.
You don't want to miss anything.
All right, so some product options. You have a fixed rate option. There is an adjustment that would happen monthly, and then there's also an adjustment that can happen annually. Just so you know, the fixed rate is a closed-ended loan, so there's no line of credit feature. Many people that investigate the reverse mortgage are looking for that line of credit feature. The fixed rate is a closed-ended loan, so you're going to qualify for a certain amount of money. And often it could be a lot less than the line of credit, and I'll talk about that later on. So it's kind of a closed-ended deal. You take a certain amount of money and you're done. If you make payments, it will certainly reduce that loan balance. You can't get the money back out. Whereas with the line of credit, we have either a monthly adjustable program or an annual adjustable program. You can pay in and take out, and you will have a line of credit available to you. And then you have the Home Safe program. So FAR stands for Finance of America, is the name of FAR. They are actually owned by a parent company by the name of Blackstone Private Equity. which happens to be the largest private equity firm in the world. And they're the ones that are behind this private jumbo program that was just approved in July of 2019. But it only carries a fixed rate product as well. But we do go up to $4 million in terms of loan sizes, where we're going to be much more limited with the government insured program, as we're going to learn soon. All right. So principal limits. This is kind of reverse mortgage lingo. Principal limit is really loan to value. It's the percentage that you can borrow against your home. But in the reverse world, they call it a principal limit. So the initial principal limit is defined as the maximum amount available to a HECM borrower or a reverse mortgage borrower at the time of closing. The principal limit is calculated using tables provided by HUD, Housing of Urban Development. These include the age of the youngest borrower or the eligible non-borrowing spouse, right? So if it's a non-borrowing spouse, that's going to be the younger borrower. The home's appraised value, and there's a limit today, and it's every year it seems to go up in this economy, but today it's $765,600. So if your home is worth $1 million, you are going to get only a percentage of up to $765,600. You won't be able to get into the $1 million of equity. The private jumbo, you'll be able to do that. But again, the percentages are a little bit different. So you'll get a percentage of up to $765,600. And at age 62, again, you're qualifying for a touch over 50% today against that number. The third variable, which is the most powerful variable, is called the expected interest rate. And how that's calculated is, and we'll get a little bit more into this later on, but the lender's margin, the margin is the fixed portion of the interest rate, which runs about 2% today, 2.25% in that area. And then it's the 10-year treasury rate. It's the time frame that banks around the world are borrowing money from one another on a 10-year time frame. And that's under 1% today. It's very low. So that factor, what they call the expected interest rate, that goes into this formula along with the property value, right, your home value, as well as the age, and it gives us that 52% that I'm telling you about at age 62. And you'll see in some slides that they're going to represent at age 62 maybe 47%. And that's because a year ago or 6 months ago, 10-year treasury rates were higher. They've come down, which increases the principal limit. Okay, some additional factors. Some additional factors contributing to this available principal limit. So certainly the older you are, the higher that principal limit is. All right, but again, it's really the expected rate that is most powerful in determining that. And here we go. Highly expected, the higher expected rates generally result in lower principal limits, and lower expected rates would mean higher principal limits, right? Any mortgage liens do need to be paid out of the proceeds, out of the qualifying funds. So if you have an existing first mortgage or a home equity line of credit, those all need to be satisfied first, and we'll need enough money to do that, right, to qualify. And then afterwards, you would have available funds, whether it be a fixed rate or a line of credit. So in the example below, it's illustrating the difference that age can make in determining the available proceeds. So here they're using a $400,000 valued property. And at the time of the illustration, this expected interest rate, they were using a 4.35 interest expected rate. It's about 1% less today. So here you go. Principal limit factor is showing right around 45%, and it's actually closer to 52% today. All right, age 72, same thing. So against 400,000 at age 62, your initial principal limit, your starting point is 178,800. At age 72, it's showing you at 50.2% against the 400,000. In actuality, today it's a little bit higher again. It's about 57%. So these numbers are actually about 7% higher, or 5% higher. It's about 52% at age 62, about a little over 55% at 72, and about closer to 64% at age 82 that you're going to get against the home value. All right. And this is always changing with expected rates, with 10-year treasury rates. So let's talk about a little bit about some program features. So for the line of credit, which is an adjustable rate loan, the line of credit, the money that you're not using actually has a growth component. And this is what people love about this loan is, so you're qualifying for 50% against your home value, But if you're not using the money, whatever portion of that money you're not using is also growing for you to use. And how the growth rate works is it's growing at the same rate that you're being charged to borrow the money. So it's going to provide you the ability to borrow more than that 50% over time. And we'll talk more about that as the deck goes on. So there's a line of credit feature. There's also a tenure feature. Tenure, T-E-N-U-R-E, means that you're going to spin off whatever money is available to you, and you want a guaranteed payment for life. So every month you'll get a fixed payment. Regardless of what goes on with your home value, what goes on in the world with interest rates, you're electing almost like for an annuity payout. Every month you're going to get a certain amount of money for as long as you live. You live past age 100, they keep paying it past age 100. All right, term, same thing. You're setting up a specific term. Maybe it's not to age 100, which a lot of these illustrations will show you, going from 62 or 65, whatever age the youngest qualifying borrower is, it will show you the schedule going to age 100. Term would mean, no, I only want this amount of money fixed for 10 years or 15 years or 5 years. And then there's an upfront draw, meaning you could take any amount of money that may be available to you within reason. And we'll talk, there are some caps in the first year, what you can take. But that would be an upfront draw, and you can do a combination of these as well. And you're not married to any payment plan. This is a very flexible type of line of credit. So you can take money out, chunk of change immediately, and then leave it in the line of credit or spin off a monthly payment. All right. But for the fixed rate loans, as I spoke about earlier, it's a one-shot deal. You're getting an immediate lump sum at closing and you're done. All right. Again, the feature of the line of credit, the unused line of credit, again, is going to grow at the same rate as the interest and FHA mortgage insurance. Right. So right now you're looking at a bank rate of around 2.5%, and the government insurance ongoing to provide that non-recourse feature where there's no personal liability is 0.5%. Many of you may be familiar with the acronym PMI, private mortgage insurance, that is often associated, or mortgage insurance that's associated with FHA loans, or anytime that you're buying with financing and not putting down 20%. So this loan also carries the government program at 0.5%. So if the bank's charging you 2.5% and the government's charging you 0.5%, you're effectively being charged 3% on the money that you're borrowing. That also means that your line of credit is growing at 3% for you to use. This line of credit can never be frozen or change, or due to change in the value of your home. There's no term or limits. It's not due in any particular time. The money's only due when you stop residing in that home as your primary residence. All right. And you can always make payments if you choose to. You pay it down and retake it later. There's no prepayment penalties on this loan. So it's a very flexible line of credit. All right. A lot of people, I make a segue and I talk about the financial crisis time when banks are shutting down those line of credits on people, or cutting how much they can borrow, taking a $100,000 line of credit or a $200,000 line of credit. We were in that financial crisis and banks just shut them down, or they took half away, then give you the ability to borrow. This is guaranteed by the government. They can never do that. They can never freeze your line of credit like we saw with the financial crisis. And just most recent with COVID-19, we saw a lot of the big banks getting out of home equity line of credits, traditional home equity line of credits, completely. This is an illustration or a chart that says, HECM line of credit now or in 10 years? Over my career, I've always heard people saying, should I delay doing the reverse mortgage? I heard you get more money the older you are. And people have this notion that the longer you can prolong having to do it or create that line of credit, the better you're going to be off. And it's really not the case. It makes most sense that if you know, and a lot of times you don't know, but it's a great idea to start the line of credit early, because you don't know what is in store for you in life, right? Your life is unknown, what's going to be in the future. So this is an illustration showing you that if you started the line of credit at age 62, and that was the lower number that we saw before, about the 45%, 178,800, and you never touched it, at age 72, it would have grown to 277,000 for use. And if you look across that, if you took out the line of credit at age 72 in the same environment, you're only starting off with 200,000 available. right? And if you drop down to age 82, that 178 due to the growth, right, compounding on itself, you now have 430,000 available. If you look to this loan at age 82 in the same environment, you're only gonna have 311,000 available to start. So it definitely makes sense, even if you don't need the money, to look at this loan and maybe establish a line of credit and just leave it and let it grow. You're basically insuring to make your home liquid, right? Real estate's a great investment, right? Everyone knows real estate's a great investment. The problem with real estate, if there is a problem, is it's not liquid. So the only way to say, oh, I have all this money, or I have the ability to take that money, the equity out of the house, is you either have to sell your house, right? Or you have to take a loan against your house. This is a loan against the house. And today with the interest rates where they are, it makes a lot of sense for a lot of people, and not just the last resort type, borrower. Moving on. I always get questions. Why not just do a regular traditional home equity line of credit versus the reverse line of credit? So let's take a look at that. Right? With both loans, you retain ownership. I hope there's not the still, mentality out there. And if there is, I apologize, but there's always been this myth that you do a reverse mortgage, you no longer own your home. That is not true. It's the furthest from the truth. We don't change the vesting on the deed. You own the house. It's a loan like any other loan. The difference is it's going to give you flexibility of whether you want to make no payments. Maybe you make an interest only payment, which would keep the balance in check of what you're borrowing. It wouldn't go up. Or you can certainly make principal and interest payments whenever you choose to. But no monthly mortgage payment is required. With a traditional home equity line of credit, you're going to have to make that interest only payment every single month, regardless of what's going on in your life. And again, life happens. So if you're an older borrower and you have a line of credit and something happens in your life where now you can't make that payment against the line of credit, that's going to damage your credit. It's also could potentially put you at risk for foreclosure if you have an issue. That will never be the case with the reverse mortgage because you technically don't need to make the payment. With the traditional line of credit, there's no growth of that line of credit. You'd be lucky to even get 100,000 in today's environment. And again, most banks are not offering lines of credit, certainly to those who are no longer working, that are living on pension and Social Security income or retirement income. Home equity line of credits, at least large, anything over 6 figures, I haven't seen really available to the public in this environment. Can never be called a recast. Again, we saw in the financial crisis that they can call these line of credits in. They can't do that with the government insured program. Non-recourse, you'll never owe more money than the value of the house. You can, probably not with a traditional line of credit, but certainly with a regular mortgage, you could, if you stop paying on it and we get an upside down market, like we've seen back in 2008, you can certainly owe more money than what the property is worth and still be liable to make that line of, home equity line of credit payment. So there's no risk of foreclosure with a traditional line of credit. There is. I think the biggest reason is, if you do plan on staying in the house, the home equity line of credit is after 10 years, you have to do something else. Then you have to pay the piper. That interest only payment is now going to go up threefold on you because it's going to be amortized over 20 years. It's a 30-year schedule. You've already enjoyed the 10 years of paying interest only. And now you're going to have to amortize that loan over 20 years and make principal and interest payments. And that often puts someone into payment. All right. 10-year payments. I'm going to skip this slide. That's again payment for life. We spoke about that. Term payments we spoke. Again, it's for a designated specific time. You would want to take your money. HECM for purchase. I think this is awesome. And I think, I would say only about 10% of the professionals I speak to know this financing even exists. So what is a HECM for purchase? Let's read it. A HECM for purchase requires a borrower contribution based on a percentage of the purchase price and the borrower's age. I'm going to call it 50% to make this presentation a lot easier. So the balance of the funds for the purchase come from the HECM loan. So the bank is going to advance 50% towards the purchase price and a one-time contribution from the buyer, right, our homeowner, whether that's from the proceeds of a sale or retirement or cash, whatever it may be, they're going to put 50% up. Right? It's got to be the primary residence and it's got to meet FHA guidelines. What are the benefits? Think about all that money that you're unlocking. Someone doesn't have to put $500,000 cash back into an illiquid asset, right? Now they have, maybe if they put down 250, they have 250,000 that they can do other stuff with, right? Our seniors are active seniors. They want to take care of their children, their grandchildren, education. They want to travel. They want to enjoy their life. And they're used to borrowing. No one's to say that they can't, make an interest-only payment on this new mortgage that they're creating for themselves. Although, again, monthly mortgage payments are not required. Payment is deferred until a maturity event occurs. They're definitely less money out of pocket, right? They're preserving most of their savings instead of spending it on their home. And they can also get more home for their money. It may set them up where maybe they were looking at a $500,000 purchase in retirement, and now they're looking at a $700,000 purchase. So it enables someone really to, I like to say, right size. It doesn't have to be downsize or upsize. I really think the right terminology today is right size, but using financing that gives you the flexibility whether you want to make a payment or not, I think is huge, especially in the later years. When if you were to set up a traditional mortgage, I hope we all know that in the first 10 years of any amortization schedule on a traditional mortgage, you're just paying the interest. Why not set up a loan that, if that's your goal, that you're making just the interest-only payment? And it will certainly be a lot less than making a principal and interest payment. All right. And again, here's the opportunity to right size their home. All right. And that could be very well, we see it. People want to be closer to family, especially in this environment that we're all living in. Right. So here's an example of a purchase. So we have a 62-year-old borrower. That's the qualifying age of, that one borrower needs to be. They're looking to purchase a $400,000 home using this program, HECM for Purchase. The borrower, and again, in this example, it's a little bit, they're gonna have to come out of pocket with more money. It's showing you that they're qualifying for about 45%. So that in this example, they're providing $233,000 of their own money towards the $400,000, and the bank is going to advance the difference of roughly that $176,800, I believe it would be, right? All right. So here we go. It's a one-time payment at age 62 of $233. If we were 72, it'd be $211. At 82, it'd be $177. And then we got, the different price variations as well. So if we're at $500,000, we need a $290,000, payment from our borrower. But think about that. That's $200,000 in this example, over 200, close to $210,000 that stays in our homeowner's pocket. To, that's their legacy. That's money that they can put back into the economy and spend through their golden years, hopefully smartly, and using the money wisely. Right. In this example, again, it's using an expected rate higher than where expected rates are today by at least a full percentage point. And it does assume, you should know in terms of closing costs. I know many of you may have questions about closing costs that we'll address. 2% is the biggest charge, and that's the government insurance, and it's financed in the loan, and it's based on the appraised value, again, with those caps. So if we're speaking about a $400,000 purchase, $8,000, 2% of 400 is going to the government to insure this loan. I will like to say, though, in New York State, you are avoiding any New York State tax. So depending upon whether you're buying in Long Island or the boroughs, you're saving that 1 to 2% from traditional financing. One way I like to sugarcoat it. But yeah, I think that insurance from the government is worth its weight in gold, makes the loan personal liability. There's no stress on the heirs that, they can only be left equity one day. You can't leave debt on this loan because of that non-recourse feature. Origination fees do, change from lender to lender. I've separated myself in this business to be extremely competitive, and most often usually have no origination fees on the loans. But you will have title insurances and settlement fees like you would on any purchase loan or any refinance loan, right? No different, right? You need to insure a good title. You need to have a settlement attorney. In fact, this loan calls for 2 attorneys today in New York State, one representing you, the borrower, and one representing the bank. All right, HomeSafe. All right, HomeSafe is Finance of America's reverse proprietary jumbo reverse mortgage product. I've been waiting my whole career, and it just came out in last summer, July of 2019, to really tackle our metropolitan market. It really is, it's a game changer, and just people don't know about it yet. So HomeSafe was designed specifically for homeowners who have higher, higher value homes. And it's also qualifying at age 60. There's no government insurance, so there's no 2% charge on this loan, which is nice. And the lender, Finance of America, and their parent company, Blackstone Private Equity, still gives you the insurance of that non-recourse feature. They're just going to let you borrow a little bit less than the government insured program in terms of the percentage. So at age 62, you're going to see more like a 30% number against the home value, but it's against the true home value. So if your home value is 2 million, it's going to be 30 to 35% against 2 million, right? Money that we can never see or get, get against the government program. So here we are, home safe features. You got higher value properties. We can lend up to $4 million. That would probably, mean we have a $12 million property in Manhattan somewhere or on the North Shore. We have lower fees. Again, no mortgage insurance premium. There's no line of credit yet in New York, so it's a fixed rate. So you don't have to take all the money. You can forgo some of the money if you don't need it all. You take what you want at closing and you're done. Condos, again, I had said this earlier, they don't require that FHA approval as long as the price point is $500,000 plus. Right, so that's our home safe jumbo. Think about condos in Manhattan. Think about every property that seems to be over $1 million today. This can start solutioning those loans as well. So here we go. Cost, I think I went over. We got 2%. That's, again, just on the government insurance program. Origination fee depends on the loan product and lender. And then you get your third-party fees that I spoke about. This is a little caveat on the government program that they put into place just around 2014, 2015. So initially, when you do this loan, they're not going to let you borrow more than 60% of what you qualify for in the first year, unless you have a lien that needs to be paid off. So if you're free and clear and your house is worth $500,000 and we're saying that you qualify, let's say $250,000 and there's no lien to pay off, you're only going to be able to take 60% of that $250,000 in the first year, which would be $150,000. The remaining funds that you're available to will become all available in the second year. It's just they found that whether it been homeowners didn't know what they were doing, they weren't advised properly, they were taking the money too quickly when they had no business taking a lump sum out of the house early on, and they wanted to make sure that borrowers were in tune that, hey, you got carrying costs to pay. We don't want you taking all your money in one shot. So unless there's a lien, they're only going to let you pay, take 60% of what you qualify. Same thing with the fixed rate, and that's why with the fixed rate it can be limiting because you're not going to have that line of credit in year 2. So with a fixed rate, without having a big lien, you're going to qualify for 60% of the qualifying funds. So it'll be $150,000 and you're done. So let's take a look at the example. Mandatory obligations are less than 60% of the principal limit. You have a 62-year-old borrower, home value $400,000. Again, they're saying the expected rate is higher than where it is today. So available, $178,800. They're only going to make 60% of that number available, which is $107 in the first year. All right, and then you'll have the balance of the line of credit showing $71,520 plus whatever growth over that year available after the year. All right. If it sounds confusing, it is a little confusing when you first take a look at it. All right. Another example is, let's say you have mandatory obligations greater than 60%. Same example, but here you have a mandatory obligation of $130,000. So they're going to let you pay off that $130,000, and they'll give you another 10% on top of the principal limit. So 10%. Their principal limit was $178,800. So you'll get another $17,800 if you want in the first year. All right. So they're going to naturally let you pay off a lien and give you another 10% more. Would be the best case scenario. All right. Life expectancy set aside. So they're established at closing and payable only taxes, assessments, insurances, hazard flood. So what they're saying is, you can elect, if you want your taxes and insurances paid from the loan, we could certainly do that. They're going to set that money aside based upon your life expectancy. They use age 87 roughly to do that. But most people want their own flexibility to pay their taxes and insurances. And we know in Long Island with taxes and insurances well over $10,000 a year, that's going to basically take all the available funds that someone may have, and it's just going to be parked into escrow. So it's not something we're looking to do, but although sometimes we have to do it based upon in order to qualify somebody. So if somebody had some problems, with paying their taxes and insurances in the past, it may be the only, option for them to get the loan is for them to have to do that. This is a great thing that I think people don't really appreciate or know about, especially my trusted partners like attorneys and accountants and financial planners. They love hearing about these consumer protections. It makes them feel more confident to say, you know what, I'll refer to reverse mortgage, as opposed to hearing maybe some negative stuff that they heard 10, 20 years ago. So every client has to go through a mandatory FHA counseling, all right? They're required for borrowers, non-borrowing spouses, powers of attorney, anytime there's a trust involved, if there's a life estate where children may have ownership, everyone's got to be in the know, all right? So they're going to speak to somebody outside the loan officer to kind of review the agreement of the reverse mortgage, that it's a loan, the requirements to pay taxes and insurances, and any questions that maybe weren't, if you weren't able to ask the loan officer, is a great opportunity to ask the counselor. All right. Financial assessment. We have to determine that you have the financial capacity to pay those ongoing taxes and insurances and maintain the property. We have the non-borrowing spouse rules, so we can make sure that they're going to be able to stay in the home as long as they could, again, afford the ongoing taxes and insurances if their spouse predeceases them. We got the non-recourse protection, so you can never owe more money than what the property is worth. So what that means is you can only leave equity to your heirs. You can never leave debt on this loan. And there are no prepayment penalties. So I spend a lot of my time educating my homeowners as well as trusted partners about maybe making the interest-only payment towards this loan to keep the balance in check, to help preserve the equity if that's a concern for heirs. And often it could be. But so we'll go through that and see, on $100,000 or on $200,000, how much money would you have to pay so that balance doesn't increase each year? So to give an example, on $100,000 at a prevailing interest rate of, let's say, 3.25%, right? That would be $3,250, $3,250 in interest for the year. If you wanted to keep that balance in check, divide that $3,250 by 12, and it'll tell you $270 will keep that balance in check. It will never go higher. If you don't make the payment and you're being charged 3.25%, well, at the end of year one, then you'd owe $103,250, right? And the negative, if there is a negative to be looked at with this loan, it's really if you don't make the payment and looking at the end result. So if you had an immediate need to pay off a mortgage for $200,000 and didn't plan on making payments ever again, you fast forward about 17, 18 years in this rate environment, and you're going to owe double. That's the negative. All right. You can't have your cake and eat it too. So there's got to be a catch somewhere, and that's the catch. But you always have the right to make the interest-only payment and keep the balance in check. So the loan process, this is part of it. It's getting an education. All right. So you're going to have a loan officer like myself to help determine, is the reverse mortgage a right solution for you? And if so, what type of reverse mortgage are we speaking about? How are we going to structure that? So we'll assess your individual needs, your financial situation, hopefully, speak to anybody within that has a decision in this process, or anybody that you would like to be part of that decision-making process, I think is important. They'll also make you feel good about the transaction as well, to see if it's right for you and if it's a right fit. So we'll assess your needs, your financial situation. We'll speak to your trusted advisors. All right. And again, we encourage you to get them involved, family members and trusted advisors. Counseling, we spoke about. The session, they say 60 to 90 minutes. It's probably more like 45 to 60 minutes. And hopefully it's a review for you if you're getting the education from the loan officer first. All right. It can be done over the phone. There are some states, not New York, that do require it face-to-face. In New York, there's that opportunity as well. So what's the process look like? There's an application involved naturally, as well as that counseling before any services can be ordered, like title and appraisal. All right, but you're gonna get, you're gonna give income the same way you would give income on a typical loan. I'll need to, source income for Social Security or pension or a job for 2 months via bank statements, your award letters, your 1099s you get at the end of the year. We'll get proof of your homeowner's insurance. But myself, as well as whatever loan officer you may be working with, should be holding your hand, along the whole way. Once the loan is approved and final documents are ready for signature, then, a closing is scheduled. Right? And it's just like a refi. If we're talking the refi, there's a 3-day right to cancel by federal law in New York. So even after everything's signed, there's another 3 days. On a purchase, just like a regular purchase, there is no rescission. Loan funds that day, and we're changing, we're changing, the keys are being passed. All right, there isn't an appraisal that's done. And sometimes they can call for a second appraisal. They kind of, it's just an FHA rule that they adopted. They want to make sure that we're not lending too much money too quickly to somebody. So they do have a check in there. I haven't seen any real adjustment downward, but they will take the lower of the two appraisals. And from my experience, when I've had loans that required second appraisals, there hasn't been that much of a fluctuation. I think 20,000 has been the most I've seen an appraisal decrease by, because a second appraisal was ordered. All right. And you could also refinance these loans, which I've done quite a bit of. When someone has a reverse mortgage, it can be refinanced into another reverse mortgage as long as it makes sense. And often it does in an environment, where you have home values increasing and interest rates decreasing. So that can very well be an option. So Section 5, I'm going to go with some scenarios. This is just some quotes out there and some of the financial publications that you may have seen. The powerful financial option can be an important part of retirement funding strategy. HECM uses a unique, HECM's uses are as unique as the individual adult homeowner it's designed for. So it really is how you treat it is, similar to like a line of credit, is where it can be real beneficial. The use of a HECM could afford the opportunity to enhance the quality of life. That's what it's really all about. Over the years, and I would say I've done over 500 loans in my career in the reverse space. Everyone comes away knowing what they've gotten into. I've never had someone say, I wish I hadn't done the reverse mortgage. It's been a peace of mind. It's been a sense of financial security for them. And thankful that they've had their home equity to lean on to help supplement their income. So let's take a quick example of a refinance. All right, so we have Mr. and Mrs. Homeowner. They love their home. They love their neighborhood. They have no intentions of ever moving. All right, they have a home equity loan that's due. Right, they've exhausted that 10-year period where they were able to just make the interest-only payment, and they're struggling to make ends meet. All right, so this is more of that last resort type borrower. They still have a mortgage on the property that they need to satisfy. So they need to make a hard choice. Do they sell, or do they stay in the home that they love? We're looking at age 70, home value at $400,000. All right, and the HELOC that we need to pay off is $100,000. So $400,000 available. HECM, we're saying only $200,000 is available. Again, it would be a little bit more than that. It would be a lot more than that today. It'd be roughly 55%, right? So 400,000 times 50, it'd be about 220, 5% more. But the proceeds are 200 after paying off that HELOC. And then they're saying some cost with the government, right? That 88,000 would still be available. All right, available balance that they can use. They have no payments. Before they were in payment shock, no payments required. They got peace of mind. They're going to enjoy living in their home, and they've got cash flow. Right, they've increased their monthly cash flow by not having to make that payment, and they have an emergency 88,000 off to the side that they can use. That's growing for them. All right, the next scenario is a home purchase scenario.
Can I share a question that we have?
Sure, absolutely.
Someone wanted to know, in terms of having the home, what you just touched upon, are there inspections to verify that the home is kept in good repair?
A great question, and the answer is no. So after the loan closes, no one's coming around to see what's going on. The only problem we would have with keeping the house in good repair is if maybe a neighbor complained that you weren't cutting your lawn and there was an infestation of mosquitoes or something of that nature, or it was just an eyesore. You weren't keeping your house up to snuff. But that's pretty much it. They are going to certify that you're still living in your house as your primary residence, but no one's coming around to check that you're keeping your house in good repair. It would have to be a complaint that would probably come up through the town for that to happen.
Okay, great. And another question, Stephen wants to know, let's say I did this reverse mortgage and I go to sell my home. What happens?
Great question. It feels like it's this daunting process. Uh-oh, I'm selling my home. I have a reverse mortgage. What do I do? It's the same process as if you had a traditional mortgage with ABC Bank, right? It's a lien against the house. Your closing attorney is going to get a payoff for you. And whoever's sending you those mortgage statements on your reverse mortgage, and you'll get one every month showing you what you owe, what's available to you. If you made a payment, it will reflect any transaction history as well. But we'll get a payoff, and we'll pay it off at closing. Same way you would on a traditional forward mortgage.
Great, that's good to know. What Mark wants to know, what geographic areas do you accept applications for your reverse mortgages?
Sure. So I'm personally licensed in New York, New Jersey, Connecticut, Pennsylvania, Maryland, California. But my bank is licensed in pretty much 45 states. So if it's not me that can assist you as a loan officer, we have loan officers all around the country. And I am a certified reverse mortgage professional, so my hands and my eyes are on every file, whether it be a New York file or a file or a file that maybe I'm not licensed in. I can certainly give my input.
That's great. I actually shared your phone number on the chat, and it will also be in an email that will go out to everyone here as well. As will they be able to see this again, because this is being recorded and you will be able to see it again. So if you want to go through any of these details or share them with your family and friends, you'll be able to do that too. I just wanted to let people know because they were asking about that.
Thank you, Elizabeth. Yeah, and keep note that, again, the expected rate is showing higher than where that expected rate is today. So the money is available in all these examples is certainly 5% higher than what I'm showing you against the value, the purchase prices and appraised values.
Great.
Okay. So in this scenario, yes, Mr. and Mrs. want to move, right? They want to right size. They want to realize their home, want to move, realize their home where they raise their children no longer meets their current needs, right? So they're looking to go, but they want to move closer to family. So age 65, their existing home value, 300,000, no mortgage balance, and they're looking to upsize, looking to purchase for 450. So on the 450 purchase, they have available to them 198,000 in this example. So they're going to have to get a one-time contribution of 250. Well, they're selling the house for 300, so they have that 250. They can't afford to buy 450 if they're only selling for 300, but they have the 250 and they have liquidity efforts. They're still going to have 48,000 remaining after the one-time contribution to get into that brand new home at 450,000. Right. And again, this is taking into account about 12,000 in finance closing costs. So what did this loan do? What was it able to do? They were able to right size their home living. They wanted to be closer to family. They didn't have the resources to do it by selling for 300 and borrowing and buying for 450. They probably are not going to qualify for traditional financing with limited income, pension and social security. They're not going to fit in that, debt to income ratio box. And they've achieved, they have a loan, right? But there's no required monthly payments. They have the flexibility, and hopefully they'll get the education of what the positive would be to make a payment or an interest-only payment, and what's the potential negative of making no payment. Right? But the big key here is they accomplished the goal. They're able to relocate closer to their family. And for many people in this situation, that's the end game right there. Right? So they increased the liquidity. They didn't have to take anything out of savings. They may have had a tax event, right? Taking anything out of a portfolio. It has probably lower cost basis than where stocks are today. So that's going to create a taxable event. And this is really also why financial planners and accountants love these programs today, because they are structured, for the consumer's benefit today. Very different than maybe 10, 15 years ago. All right. Then we have an example of someone with aging concerns. So aging parents, they're experiencing some health problems, and you have adult children concerned about how we're going to pay for these healthcare costs. So in this example, we have an 80-year-old, home value again 300,000, and we're looking to stay. And again, 154,000 is available in this example. That could be structured, just take it as you need it. You could set up a 10-year payment against that money where you'll be guaranteed to age 100 plus, or a certain period of term. If you know that this is only an option for another 10 years and I'm going to sell the house, maybe you set up a 10-year term to help supplement the income with a monthly payment. And again, this is showing expected closing costs of approximately 15,000 in this example. But what are we able to accomplish? your HECM borrower, your homeowner, is able to, get the home health care funds that they need in home. All right, the peace of mind is worth its weight in gold. You got a decreased burden on the family. You got independence, right? Your family member retains independence. They're paying for their own health care from equity that they've built up in their home. It's their asset. And hopefully they're going to remain in their home for the foreseeable future versus having to go into some type of assisted living or nursing home. Or maybe that line of credit enables someone to come into the house to help keep mom and dad home. And hopefully that cost is lower than going into a nursing home or an assisted living. And it's also the wishes of mom and dad to stay in their home. All right. I know we have a few minutes and I do want to leave, enough time for some more questions, but just, I know a lot of people have heard reverse mortgages and all the negatives, but here's some great, quotes from a lot of positives. So you got Forbes, Personal Finance. A reverse mortgage can be a good backup strategy for homeowners who are concerned about potentially outliving their own, other income sources. A more flexible and potentially more lucrative approach is to obtain a reverse mortgage line of credit. Again, talking about the growth, it will continually grow each year, providing access to an ever-increasing line of credit in later years as the credit line remains in place but unused. So again, just talking about start the line of credit early, and when you may need it 10, 15 years, you're not scrambling around in crisis. How am I going to get a loan against the house? How am I going to get a loan against the house? It's already been set up. And your trusted advisors are going to love that. Kiplinger's Personal Finance, reverse mortgages at work. One versatile solution for financial flexibility and security is a reverse mortgage. It lets you stay put, get your mortgage payment if you still have one, and tap your home equity. Here's one about the HECM for purchase, Washington Post. On HECM for purchase, in addition to netting cash from the sale of the original home, the HECM for purchase, that's H for P, that borrower doesn't have to worry about making mortgage payments for as long as they remain in the home. You can use the money and you can save it for whatever you want. So meaning a one-time contribution, take the proceeds as opposed to putting it back into an illiquid asset, have that money maybe in a line of credit or maybe right in your bank account. All right, so just a couple of quotes that are out there. There's a lot of positives out there. The Financial Planners Association, I know from experience, just adopted Finance of America and that whole educational program, tutorials to get out to their financial planners, all different ways that people are using reverse mortgages in retirement. The biggest one that people are talking about now is called the sequence of returns, where someone retires and the stock market takes a big and dips down 10, 20%. There's a lot of thought now, a lot of intellectual thought that, wait a minute, don't take a distribution from retirement when the stock market's in a free-for-all or we're in a down year. Maybe you borrow from your home equity at 3% to help bridge the gap, and you let your portfolio recover as opposed to liquidating assets in the early part of retirement. And there's a lot of evidence that it makes a ton of financial sense. All right. That is my presentation for today. I'm going to go up to the chat and see if there's any questions that maybe Elizabeth hasn't answered yet.
Excellent. We do have a couple.
Yep.
Kathleen wants to know, I know you mentioned this a little bit, but what is available to a cooperative and can they qualify for something similar to a reverse mortgage?
And that was Kathleen that asked that question?
Yes, that's right.
Kathleen, I'm sorry to say that co-ops are ineligible from reverse financing. Back in 2007, for a minute, there was a program out there, and I did one in Brooklyn, and then it was gone. So it was a private program through Financial Freedom at the time, but privately enough, there was a proposal on Mario Cuomo's desk at the same time this COVID was just starting in March, and he didn't want anything to do with it. He negated the whole thing and never went to the next step, whether it be the Senate, to see if they wanted to approve reverse mortgages for co-ops. So it's not going to be coming anytime soon, I'm sorry to say.
Well, thank you for the information. Mark wanted to know, what home value range are you seeing most of your applications, and from what age ranges are you seeing from most of your applications?
It's a great question, and it's really, years ago, I would certainly say the last resort borrower in age 72 is a common theme. or someone that was a last resort borrower and that was really early in retirement, but didn't want to uproot, wanted to keep his children, you know, in high school. I've had a few of those situations back in the day, but today is really different. I'm finding today's borrower much, much different than the last resort borrower. It's someone that's looking to do this because they don't want to liquidate other funds for any other, you know, for other reasons and create that taxable event. So it's maybe the reverse for purchase. It's to satisfy a loan and to be able to do more with their finances for children and grandchildren. It's hard to say. I'm not really seeing a specific age today. I did get a flurry of calls during the COVID pandemic of people wanting to look at this loan, and some of them moved forward. Some people just wanted the education as a just in case. But for most people, it's usually satisfying a traditional home equity line of credit that they may have gotten payment shock on, or satisfying a mortgage, or it's just to establish that line of credit and kind of not have to liquidate funds because their portfolio is doing so well and they want to kind of leave that alone. And they like the idea of borrowing at 3% and choosing to make a payment if they want to. I hope that answers your question.
Thank you. Well, it just goes to show that as many people that are different, there are different reasons why people are reaching out to you and learning about it and taking advantage of reverse mortgages. We have a question from HD. What happens if house values tank during the life of the HECM?
Right. Great question. And I'm happy to say there's really no ramification. The loan is set. The contract is made at the time of appraised value, you know, when that loan closes. So right now it's like a perfect storm right now. We've never seen home values this high in Long Island. I personally refinanced my own home with my bank in April. A little too quick. I should have waited another couple of months, but it's still very cheap money. And yeah, I've never seen my home value this high. Same thing with the reverse mortgage product. People are qualifying for more money on this program, more than they ever have. I shouldn't say ever have, but certainly in the last 7-8 years, because years ago they were higher, what they call principal limit factors, but they cut those. But now you're seeing the people at age 62 being able to borrow more than 50% of their home equity because those 10-year treasury rates are so low right now. So it's really in the wheelhouse to take a look at this program. I looked at, to give you an example, I was speaking with somebody a year ago on a $500,000 property. And today, the difference based upon what the 10-year treasury was a year ago to now, it's a 10% difference. So on 500,000, it's 50,000 more available to start on this program. Now, remember, the negative on a reverse mortgage is whatever you start as a loan balance is going to double in about 17, 18 years if you don't make a payment. Well, guess what? Your line of credit does the same thing. So whatever you're not using is also compounding on the other side. So it's that 50,000 that you're now qualifying more from because of the 10-year treasury rates. Over time, that's like another 100,000 because of the compounding of interest.
Terrific. Thank you so much. Well, this has been incredibly informative. You've been so generous with your time. I really appreciate your coming here and giving us this information. Certainly, please, I encourage you to reach out to Robert. You'll get his additional contact information via email. You'll be able to rewatch this webinar and be able to share it as well. Robert Tollin, thank you so much for being here and sharing your expertise. I want to thank our attendees for spending some time with us this afternoon. And from the looks of the comments, I see that people are commenting how informative it was. So we are thrilled about that. Please join us for future webinars and keep an eye open because Robert will be back. So we'll keep you informed of his upcoming webinars so you can be sure not to miss one of them. Have a great afternoon, everyone. Stay safe and stay healthy. Bye-bye.